What if I told you that in 2026, one of the biggest investing debates in America is not about stocks, not about crypto, not even about real estate, but about two metals that have been around for thousands of years, gold and silver? One is called the king of money. The other is known as the everyday investor's metal. But here's the real question. In today's U.S. economy, with inflation still in people's minds, interest rates shifting and global uncertainty rising, which one actually makes more sense right now? And more importantly, which one fits your strategy? Welcome back to U.S. Finance Insights. If you care about protecting your money, building long-term wealth, and understanding how the U.S. economy really works, make sure you hit that like button and subscribe in the first minute so you don't miss our upcoming deep dives. It helps the channel grow and helps more people make smarter financial decisions. Now let's start with something simple. Gold and silver are both precious metals. They've both been used as money. They both hedge against inflation. But they are not the same investment, not even close. And if you treat them the same in 2026, you might be making a mistake. Let's talk about gold first. Gold has always been seen as a store of value. When people lose trust in paper money, when markets crash, when banks look unstable, investors run to gold. During the 2008 financial crisis, gold surged. During the 2020 pandemic panic, gold hit new highs. Why? Because gold is about safety. It doesn't depend on earnings reports. It doesn't go bankrupt. It doesn't default. It just exists. In the U.S. economy, gold usually performs well when real interest rates fall or when inflation expectations rise. If the Federal Reserve starts cutting rates aggressively in 2026, gold could benefit. If inflation surprises on the upside again, gold could benefit. But here's the key. Gold does not produce income. No dividends, no interest. Its return depends purely on price appreciation. Historically, gold has averaged around 7 to 9% annual returns over very long periods, but those returns come in cycles. There are long flat periods. For example, after peaking in 2011, gold went almost nowhere for years. So if you buy gold expecting fast gains, you may be disappointed. Gold is about protection first, growth second. Now let's shift to silver. Silver is often called poor man's gold, but that label is misleading. Silver is not just a precious metal, it is also an industrial metal. It is used in solar panels, electronics, electric vehicles, medical devices, and more. In 2026, with the U.S. pushing green energy and technology manufacturing, silver demand is heavily connected to industry. This is where silver becomes interesting. When the economy is strong and manufacturing is expanding, silver can outperform gold because industrial demand rises. But when the economy slows down, silver can drop harder than gold. That means silver is more volatile. Bigger swings up, bigger swings down. Historically, silver has delivered higher percentage gains during bull markets in precious metals. In the 2011 rally, silver massively outperformed gold. But during downturns, it also falls much faster. So silver is more aggressive. It behaves partly like gold and partly like a cyclical commodity. Now, let's compare them directly in the context of 2026 America. Inflation is lower than the 2022 peak, but it hasn't disappeared. Government debt is at record levels. Geopolitical tensions remain high. At the same time, technology and clean energy investments are accelerating, so we are in a mixed environment. Gold benefits from uncertainty, debt concerns, and currency risk. Silver benefits from economic growth and industrial demand. So the big question becomes, are we heading into more instability or more growth? Another factor is affordability. Gold trades at a much higher price per ounce than silver. That psychological factor matters for retail investors. Many smaller investors feel more comfortable buying silver because it looks cheaper. But remember, price per ounce does not mean better value. What matters is percentage movement. There's also something called the gold to silver ratio. This ratio shows how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has moved in cycles. When the ratio is high, silver is considered undervalued relative to gold. When the ratio is low, silver may be expensive compared to gold. Smart investors watch this ratio to decide which metal might have more upside potential. In past cycles, when gold started rising first, silver often followed and then outperformed in later stages of the rally. So if we see a strong precious metals bull market in 2026 and beyond, silver could potentially deliver larger percentage gains. But again, higher potential usually comes with higher risk. Let's also talk about volatility. Gold is generally more stable. It moves slower. Silver can swing 5 to 10% in short periods. For long-term investors who want peace of mind, gold may feel more comfortable. For investors who can handle volatility and want more upside, silver may look more attractive. Now think about portfolio strategy. If someone is using precious metals as insurance against financial instability, gold usually makes more sense. Central banks themselves buy gold, not silver. That tells you something about gold's role in the global system. Gold is considered a monetary asset. Silver is more of a hybrid between money and industry. But if someone believes the U.S. economy will stay strong, manufacturing will expand, and clean energy demand will explode, silver could benefit more from that growth story. Especially with solar panel demand increasing globally, silver's industrial use is a major factor. Another important point is liquidity and market size. The gold market is much larger than the silver market. That makes gold more stable and less prone to extreme manipulation or sharp spikes. Silver's smaller market size means it can move faster when money flows in or out. Let's also address expectations. In 2026, some investors expect gold to hit new all-time highs because of government debt and potential rate cuts. Others believe silver could outperform due to green energy expansion. But realistic expectations are important. Neither gold nor silver is likely to double every year. These are long-term plays, not lottery tickets. If you look at long-term data, both metals protect purchasing power over decades, but they are not magic assets. There are periods where stocks outperform them significantly. So holding 100% of your wealth in gold or silver is usually not a balanced approach. Most financial planners suggest using precious metals as a small portion of a diversified portfolio. So which one makes more sense in 2026? The honest answer is, it depends on your goal. If your main focus is wealth protection, stability, and hedging against financial shocks, gold likely makes more sense. If your goal is higher growth potential and you're comfortable with volatility, silver might offer more upside. Some investors even combine both. They allocate more to gold for stability and a smaller portion to silver for growth. This balanced approach can reduce risk while keeping upside potential. Before you make any decision, think about your time horizon. Are you investing for 1 year, 5 years, or 20 years? Think about your risk tolerance. Can you handle sharp swings without panic selling? And think about your broader portfolio. Do you already have exposure to stocks, real estate, or bonds? At US Finance Insights, our goal is not to tell you what to buy. It's to help you understand the bigger picture so you can make smart, informed decisions. Precious metals are tools, and like any tool, their value depends on how and why you use them. As we move deeper into 2026, watch the Federal Reserve closely, watch inflation data, watch industrial production numbers, and keep an eye on global tensions. These factors will influence whether gold or silver leads the next move. Now I want to hear from you. If you had to choose today, would you go with gold for safety or silver for growth? Or would you split between both? Drop your answer in the comments because I read them and they help shape future videos. If you found this breakdown helpful, make sure to like this video and share it with someone who is thinking about investing in precious metals. And if you're new here, subscribe to US Finance Insights for more clear, honest, and practical analysis about the US economy and smart investing strategies. Thanks for watching, and I'll see you in the next one.